Hello, we are online now. We've gone live. Like I promised, I have come to solve the ratio questions. I'm going to solve the ratio question today, and then tomorrow I will look at the business combination, and then maybe the group account tomorrow. Then next tomorrow also, or Saturday, I will look at the question today, and then investment in associates tomorrow, and look at the business combination, the conceptual framework for financial reporting. And this is exclusive account for members. Tomorrow it's not for everybody. If you are not a member also, you cannot see it. I will look at the question today. If you want to join investment in associates, the class, you have to become a member. The conceptual and the membership is AllStar, from AllStar upward. This is exclusive. Any member below AllStar members will not be able to access the video for everybody. So I have to not a member also do something for my members so that they too want to enjoy the services of the channel. Have to be members of the channel, and the membership is AllStar, from AllStar upward. This is exclusive. Any member below AllStar members will not be able to access the video for everybody. So I have to. I'm online. I'll call you back. Do something for. I'm online. I'll call you back so that they too want to enjoy the services. So sorry for the interruption. We continue with the video as I have promised. So every one of you who are able to make it to the membership, congratulations. Congratulations to my members. Congratulations to my members. Okay, I will briefly read out the question. It's on the screen. I may not spend much time reading it out because I don't want to spend much time in solving the question. 20 minutes, okay, fine for me. So the summarized financial statements of Omega Manufacturing PLC for the years ended 31st December 2023 and 2024 are presented below. Statement of profit or loss, and then statement of financial position. We have the figures for 2023 in the statement of profit or loss, and the figures for 2024 in the statement of profit or loss. Then the statement of financial position, we have the figures for 2023, 2024, 2023, 2024 for liabilities and equity, and for assets. So if you look at them, like I said earlier on, the financial statement is not shown in real form of financial statement, but it's page by page. So you have 3 pages just showing here. So you should take it that way. I will read out. I've seen that, so you can take a look at it, and I will move to the next page for the requirements. So you are required to compute A, the following ratios for 2023 and 2024. Profitability ratio, gross profit margin, operating profit margin, return on capital employed, that is ROCE, liquidity, current ratio, quick ratio, efficiency, turnover, inventory turnover ratio, days, receivables collection period, days, gearing, debt to equity ratio, interest coverage ratio. Then B, interpret the results of your ratio calculations by comparing 2024 with 2023, identifying strengths and weaknesses, explaining possible operational or financial causes of the changes. Your answer should be written in professional report style. Using your analysis using your analysis, assess the financial financial health and going concern risk of Omega Manufacturing PLC. State whether the company is improving, stable, or deteriorating. There are signs of liquidity pressure, overtrading, or excessive gearing. Investors and lenders should be confident or cautious. Support your conclusion with specific ratios. D. As a financial consultant, recommend 4 practical actions management should take in 2025 to improve profitability, cash flow, debt position, and operational efficiency. So that is the question. So this is the solution on the board. I'm going to bring my video again because I have the space for it. So that's the solution here. We're going to go through the solution. So the first one is to calculate the ratio. We have profitability ratio, gross profit margin. If you look at the question, gross profit margin is gross profit divided by revenue times 100. This 100 is over 1 anyway. So in 2023, our gross profit was 3,400 divided by the revenue 8,500 times 100. So we have 40%. In 2024, the gross profit was 3,000 and revenue was 9,200 times 100. All will give you 32.61%. You can go back to the question to see this is the revenue for 2023 and this is the revenue for 2024. You can see my cursor there. Then you have the gross profit for 2023 and gross profit for 2024. They are all there. You can see that. So that's where we're going. So we move to operating profit margin formula. Operating profit divided by revenue times 100 over 1. In 2023, the operating profit was 1.6, while the revenue still remains what it was, 8.5 times 100, it will be 18.82%. 2024, 900 over 9,200 times 100 over 1 gives you 9.78%. So if you look at it here, okay, sorry. Okay, if you look at it here, you will see the operating profits. They are here 1.6 and 900. So that's it. So you go to return on capital employed, ROCE. Return on capital employed is equal to equity plus capital employed is equal to, first and foremost, we want to show what capital employed is. It's equity plus non-current liabilities. So that capital employed for 2023 will be 3910 plus 1500. That will give you 5,410,000. Let's look at the 391 and then the 1550. So this is the 391 total equity, and then this is the 1500, the non-current liabilities, and then total equity. Then for 2024, we have 4225 plus to 600 equal to 6825. So you can also see it there. 4225, then 2.6. So in calculation, the equity is we have operating profit, which is 1.6 that we had here, plus divided by equity times 100, 29.57%, and here the operating profit is 900 divided by 6825 times 100 equals to 13.19%. So we have calculated the profitability ratio. So we go to liquidity ratio. We are going to calculate current ratio and quick ratio. Current ratio is equal to current asset divided by current liability. So here we have current asset at 2.8 divided by current liability 1.39 in 2023. We have 2.01 is to 1. In 2024, we have a current asset as 3.5 divided by 1.475, which will give you 2.37 is to 1. So we can look at the current asset in the question. Current asset in the question is this plus this plus this for 2023, that is 2.8, and then here you have it 3.5, and current liabilities 1.39 and 1.475. So that's what we use to calculate the ratio. These are the values here. Okay, sorry, these are the values here. This and this, this and this. Then quick ratio is equal to current asset minus inventory divided by current liabilities. So here we've added inventory. Of course, all of you know it, we calculated it before. So we have 1.15 is to 1, 1.08 is to 1. Efficiency ratio, inventory turnover period, inventory divided by cost of sales times 3.65. Cost of sale, inventory is 1.2, cost of sale is 5.1 times 3.65. So let's look at what it is. Cost of sale is this, and then the inventory 1.2, 1.9. We did not take average. Please note that we did not take average. We use the figure for 2023 and the figure for 2024. The reason why we didn't want to take average, if we take average, it will now be the same value for 2023 and 2024 because we don't have another year. So that's why we use it absolutely the way they are. So for 2023, you have 85.88 days, and then the turnover is 85.88 days. Then for 2024, 111.85 days. Receivables collection period. You also see receivables divided by revenue. You can see that we also use the absolute receivables, not average, because of the reason I gave for this. We have 42.94 days and 55.54 days. So that's that for, sorry, we have finished liquidity and entered efficiency ratio. So I didn't highlight when we entered efficiency ratio. So now it's gearing ratios, debt to equity ratio. Total debt equal to non-current loan plus short-term borrowing divided by equity. Now, know that there are different ways of calculating debt ratio. There are different ways of calculating debt ratio. This is the formula that we're using for this computation. So take note of that. Then this is what we have: non-current loan plus short-term borrowing. If you add it up, 1.5 plus this divided by equity, So we have 0.51 and 0.68 for the years respectively. Then interest coverage ratio is operating profit divided by finance costs. So finance cost here for 2023 is 300, for 2024 is 450. Let's go to the question to look at finance cost. It is stated. You are not to derive it. When you are to derive it, it becomes more difficult. But this one now, it is actually stated. So it's simpler. So we have 5.3 times and 2 times. So we have computed the ratio. Now is to interpret the performance, interpretation of performance. Note what we're interpreting, not just the ratio, but the performance, so that you know how you place your interpretation. So for the profitability ratio, we saw that margins declined sharply despite revenue growth. Margins declined sharply despite revenue growth. So let's look at that profitability ratio that we computed. We have 2023 from 40 down to 32%. So that is the declining. So you see that it is a comparison of 2023 against 2024. In 2023, we had 40%. In 2024, we had 32%. So there was a decline in the margin. And then ROS fell from 29.6% to 13.2%, indicating reduced efficiency of invested capital. This suggests rising costs, rising pressure, or inefficiency. So that's what the fall in ROS suggests. Either the cost of sales is rising, or there is a pressure to reduce price, or there is waste and inefficiency in the system. So that is the profitability ratio interpretation of performance. Then liquidity ratio. Current ratio improved, but quick ratio weakened slightly. So let's look at the current ratio and the quick ratio. This one is 2.01 is to 1. Then this one is 2.37 is to 1. So it means that the liquidity ratio, the current ratio for 2024 is better. Than the one for 2023. So now the assets, the current asset is 2 times the current liabilities in 2023. But in 2024, the asset is 2.37 times, which makes it better coverage than in 2023. So that's why we say that it improved. But quick ratio weakened slightly. Let's look at quick ratio and see how it weakened. Sorry. Oh, okay. Oh. Okay, I hope you can see it. Okay. Quick, sorry, let's go back. I'm trying to show the quick ratio. Here is 1.15 is to 1, but here is 1.08 is to 1. So you can see how it was. So liquidity improvement is driven by inventory build-up, not cash strength. So you see, that improvement we saw in liquidity that time was because there were more inventory. As they removed the inventory, you saw that it dropped. So cash actually fell significantly, signaling possible cash flow stress. Efficiency. Inventory days increased from 86 to 112 days. Slow moving stock or overproduction. Receivable days rose from 43 to 56 days. Weaker credit control. Both trends tie down working capital. So the two trends you saw in the efficiency ratio will only tie down working capital. Then the gearing and risk ratio, debt to equity rose from 0.51 to 0.68, higher financial risk because the gearing is growing higher. And interest cover dropped because the gearing has gone up. Definitely the interest cover will drop from 5.3 to 2.0. This is a very dangerous drop because it's more than the drop is more than half. So we have approached a danger level, indicates reduced ability to service debt. So as it is, to be more difficult to service their debt. Then overall financial health and going concern assessment. Omega Manufacturing PLC shows signs of deterioration, falling profitability and growth, weakening cash position, slower inventory and receivable turnover, increasing leverage and declining interest cover. So you can see that the profitability fell from year 3, year 1, that is 2023, in year 2, 2024. The profitability was better in year 1, 2023. The cash position was better, but it weakened. And inventory slowed down in 2024. The leverage increased, as we saw, 5 to 2. So the interest cover was very low, and which suggests pressure. So these trends suggest liquidity pressure, possible overtrading, rising going concern risk if performance does not improve. So the management of the company must try Omega Manufacturing PLC to change the narrative in order to maintain going concern. If they continue like this, going concern will be doubted and there might be problems. Conclusion, the company is financially weakening and investors to lenders should be cautious unless corrective actions are taken. So with this, you're able to advise the investors and the lenders on how to handle the issues of that company. They should be cautious. Recommendation to management: cost control and pricing review to restore profit margins. 2, improve inventory management to reduce holding period and free cash. 3, strengthen credit control to shorten receivables days. And 4, restructure debts or reduce borrowing to improve interest coverage and gearing. So these are the recommendations that you could give to management in order for management to be able to handle the threats in their business. so that the investors will also be at rest. As it stands, it's obvious that the investors should be cautious in their investment. So this is the ratio question and the solution to the question. You can see that it's not as difficult as we have made it to look. By the time we go on to solve the other questions, you'll also find out that these questions are not too difficult to handle. It's just a mindset. So everyone should try the best they can to study the question more and more. For now, I will be logging out. I won't be able to do the other questions today. The other questions will be done tomorrow. Those who have not joined should try and join. John, I have seen you. Finally, you have subscribed. You have joined the membership. And thank you. So is there any question anybody want to ask? Any question? If you have questions, let's attend to them before I sign off. For the few people that are there, if you have questions, let's attempt to them. Let's attempt those questions. You can ask the questions so that we can handle them. If there is no question, then we will call it a day. Thank you all for joining. We will have another session tomorrow. You can continue to study. Thank you very much.